This is the Retirement Key Podcast with Abe Abish, founder of Abish Financial Services.
And I'm Heather Branch here with Abe, asking for his insight on the things you can be working on now as you get closer to retirement, or perhaps are already retired. You work so hard to earn and save this nest egg. Let's make that money now work for you. The retirementkey.com is where you can start the conversation with Abe and his team. We also have links posted in the show notes, or again, find us anytime, the retirementkey.com. Mr. Abish, let's just dive right in because
let's do it.
People have questions about the market. But here's my thing. Do we really, is it that we should be having surprises or questions, or is it just we're so freaking spoiled by the last 13 years?
It confirms my belief, our belief as a firm, that there is way more pain on the downside. There's way more pain when the markets are going down and people are losing money than there is joy on the upside.
Yep.
Everybody takes the good returns. Everybody enjoys when the markets are up. Portfolio values are up. Market indices are up. But when things turn around, and we have a lot of clients in the last week or so, we've had a few reach out via email and phone like, hey, should we be more concerned, than we are? We see what the markets have done.
Yeah.
But our clients have already done all the proactive planning in advance. We talk about this nearly every week. And this goes to show you how timing the markets is darn near impossible.
Right.
It's pretty much impossible.
Right.
And sometimes people will say, Heather, they'll come into the office and say, well, can I just continue to ride the market up? And then when it turns around, I'll make a change. No, you can't.
Is that a good approach?
No, it's a terrible approach. Right. And you know what? Things can change and turn around on a dime in a day.
As we were seeing.
In a day. In 2 days. And then here's what happens. Things can turn around so quickly.
Yeah.
And markets can be down 5 or 10%, as they were in the last week in just a few trading days. And then you're like,
now what?
What do I do? Do I hang on? Do I hold on? Do I not make any changes? Do I try to sell now? No. You need to take all the guesswork and all the emotion out of the equation when you're building a retirement plan and stick to your long-term plan and goals. And if you haven't already, and you're listening right now, and you haven't taken some chips off the table and gotten serious about this run up in the market and protected some of your life savings entirely from downturns, right? And just you think about how well you've done and how well the markets have done. If you haven't gotten out in front of that yet, now's the time, right? Because who knows what the markets are going to hold in the future.
Also, let this little ruckus that we're experiencing maybe be a little bit of a lesson. Take it as a little hint, if you will, from the universe.
2022 is it almost seems like it was far removed. 2008 is a long time ago. COVID seems like it was a long time ago. And then all of a sudden, the markets are riding high and going way up until they're not.
Well, let's talk about the current circumstance. Kind of like what's going on. So some people are pointing blame at unemployment rates.
Yeah.
Some people are saying, well, we saw some of these tech stocks, the big tech are showing that they didn't have as good at earnings, Amazon, Intel, NVIDIA.
Correct.
So here is Steve Sosnick recently on CNBC and what he had to say.
Sure.
Right now, you want something that's a bit recession-proof because the bond market, with the moves that we're seeing, they're screaming at us right now to tell us that they think we're looking at a recession. So this sort of bodes for a bit more of a defensive posture until we can really see if this is a temporary storm or bumpy landing, so to speak, or if it is indeed a harder landing.
Bond markets are screaming, or bonds are screaming at us. There are people screaming for Fed rate cuts. Let's do this. Let's get the market back on track. He said a term that you have said a lot here on this program, the idea of recession proofing.
Right.
So let's talk about that.
Yeah, and basically what he's saying is now is a time to reduce risk. I mean, take some chips off the table.
Yeah.
And you know what? You also need to kind of follow the money and pay attention in the markets. I don't know if our listeners saw, but just a few days ago, Warren Buffett Berkshire Hathaway sold 50% of their holdings in Apple. Sure enough, right on time, right? They didn't miss all the downturn, but they sure missed a good bit of it.
Yeah.
And so, at the time, Apple was their largest holding, and that's their way of saying, hey, we've done really well, and let's take some chips off the table and rebalance and reallocate. So there's a lot going on right now. One of the biggest things that kind of spooked the markets on Friday was this labor report and just the jobs report. Also, there's concern that the Fed has kept interest rates too high for too long, maybe should have cut rates sooner. Now people are talking about maybe an emergency rate. Some people think that if there's an emergency rate cut, how much in trouble and how bad are the markets are really are they right now if we have to have an emergency rate cut before September. Nonetheless, we'll probably see one in September. But there's questioning, has the Fed held on to interest rates for too long? There's also the unwinding of the yen carry trade, and basically that's loosely defined as investors borrowing in low interest rate currency and investing back in U.S. assets with higher rates of return. We've seen a lot of fear and volatility because of this. We've seen the VIX index.
That's another one we've talked about before here on this program. Explain what that is. Clarify that a bit.
Yeah, it's a volatility index, Heather, and it kind of shows, hey, what kind of fear is out there and volatility in the markets. And it hit its peak higher than the peak that it hit during COVID, March of 2020. So
that's where we are right now. Yeah.
Yeah. There's also another index that CNN Money puts out. It's called the Fear and Greed Index. And just a couple of weeks ago, that thing was turned all the way to the green. Like, hey, people are greedy, people are investing, people are gung-ho. And now it's all the way back to the left in red.
Really?
People are fearful. And so all this to say, this is healthy and normal. Like, if the markets are just going to shoot up for a couple years in a row, don't you think the markets are going to turn around at some point? Of course they are. And so it's easier to kind of relay our message, when I think it's easier to relay our message to listeners and people all across the DC metro area when things are going well, because it's like, well, things are going well. Now's the time. But what happens is people get so caught up in the markets and they think, well, I can continue to make my 20 or 30%. I don't want to take chips off the table just yet, until they get caught off guard and like, man, I wish I would have done that. So unfortunately, sometimes it takes some volatility for people to realize this can happen in a day. This can happen in days. August and September is kind of known for some of this as well. Summertime, they have dog days of summer in the markets. We've got a lot going on, an election, interest rate environment. We've got some wars going on, the Middle East, a lot of uncertainty. So we need to create as much certainty. We need to control as much as we can possibly control when it comes to our retirement and financial plan by taking chips off the table, protecting our life savings, not just from market downturns, but things that can also impact it down the road, like higher taxes, healthcare events, making sure we pass on our monies in the most tax efficient way. If you're listening right now and you say, you know what, Abe, I haven't gotten really serious about my retirement plan, my financial plan. I haven't taken some chips off the table. I haven't done what I need to protect my life savings from all the risks that could mess it up. Then go to the retirementkey.com. Click on the Contact Us tab at the top of the page. We can begin to have conversations about providing you that recession-proofing analysis as well.
You can also click on the links we've got posted in the show notes to go to our website, which is, again, theretirementkey.com. All right. Obviously, there's been a lot of concern by a lot of investors because of the market volatility we've seen. The tech companies that we've been worshiping and up on their pedestal, Amazon, Nvidia, Intel, talking about laying off people.
Yes.
We're seeing their overall projected earnings are lower than expected. All kinds of weird things are going on. So when it comes down to the end user, though, of course, the investor, particularly the folks you work with, those that are getting close to or in retirement, now we got to focus on what we can do despite the market to protect ourselves.
Right.
Of course, no matter what's happening with the market, good or bad, the number one fear of retirees, Abe, is
running out of money.
Running out of money. So what can we do to prevent that from happening? Financial journalist Bob Powell was talking to The Street, saying that one way to help prevent this fear is with guaranteed income. Here's what he said.
Longevity, the fear of outliving your assets, is a very real risk that you'll face. Equities, investing in stocks, doesn't always manage and mitigate that risk. But things like annuities, income annuities, deferred income annuities, those are tools that you could use to manage the risk of outliving your assets or the risk of longevity. So think about your expenses in retirement carefully, and then think about the risks that you'll face in retirement and what tools you use to manage and mitigate those risks.
What tools you use to manage and mitigate those risks. Annuities being one of those options. Let's discuss how we make that work for ourselves.
Sure, Heather. Yeah. The traditional way to put together a retirement plan portfolio is stocks, bonds, and maybe some cash. And then sprinkled in there, depending on the firm, that you work with, you might see some real estate, some crypto, some gold, silver, some alternatives to kind of even more diversify risk inside the portfolio.
Right.
Well, as a firm, we have seen years like 2022 where the entire stock market and bond market was down. In 2022, stocks and bonds were down simultaneously for the first time in 50 years at the same time. Usually stocks and bonds complement each other. One zigs, one zags. Bonds are there to soften the blow.
Okay.
But with bond funds, when rates rise, as they have 11 times in 2022 and 2023,
Right.
bond values fall. And when interest rates lower, bond values can rise.
Okay.
Right? So in a decreasing rate environment, as we saw during COVID, and as we're likely to see here into the near future, short-term treasuries, short-term fixed income could be a good place to de-risk and protect some of our life savings. Certain types of annuities, they get a bad rap out there, but there are a lot of good ones, and people just need to be educated. Fixed and fixed indexed annuities. Currently, with rates being high, fixed rate annuities are paying anywhere from 4 or 5, even over 5% guaranteed, kind of like a CD would, but even higher yields sometimes than a CD with the safety that someone's accustomed to in a bank CD with principal protection. Fixed indexed annuities can also make for a good bond alternative. If you think about what you would earn long-term over your lifetime on the bond side of your portfolio, it's usually between 3% and 6%. Matter of fact, every time we're sitting down with someone at our conference room table, Heather, we'll show them the Vanguard Bond ETF. That's BND, ticker symbol.
Okay.
Well, since inception, the last 17 years in a row, that bond fund has averaged, its annual average yield is 3%.
Okay.
Well, if you think about that, we're barely keeping up with inflation. Then when interest rates rise, bond values can and will fall. In 2022, that same bond fund was down and the bond markets were down between 11 and 15%.
Right.
That's not safe to a retiree.
Right.
Being down 11 to 15 on the safe side of your portfolio, or quote unquote safer side of your portfolio, is not safe to us as a firm, nor is it safe to our clients.
Right.
Our clients need and want something in there that's not going to lose a penny no matter how far the markets fall.
Sure.
That also means they're going to make the least amount on that piece of the portfolio. But if you think about building a retirement plan portfolio like building a house, the foundation of the house should be rock solid. Even the Bible even talks about this. The wise man building his house on the rock, the foolish man building his house on the sand.
Right.
You can't build a house on sand, people.
That's right.
The sand, there's no foundation. You need to build your house on a rock. You need to build a retirement plan on rock solid foundation. Well, that's where some annuities can come in to replace income, to be there for principal protection in the portfolio. They're not perfect. Nothing is.
That's right.
Everything has pros and
Even
cons, but they
cash
can really make
can be
for good bond
imperfect.
alternatives.
Yeah.
Yeah, it doesn't take a lot, Heather, to make more or to be in the same yield range as a bond fund or even an individual bond with perhaps even more principal protection. So we just had a couple come in from Gainesville who really needed to protect a piece of their portfolio. 3.2 million saved, a 6 on our risk scale, just middle of the road investors retiring this year.
Okay.
3.2 million saved.
Nice.
80 to 90% of it in stocks, knowing when they came in they needed to reduce risk right away.
Okay.
So basically what we did is we removed about 35% of that money from the stock market, principal protected, so they could rely on 30 to 35% of that money and never worry about going down, right, due to market downturns. Yield expectations, growth expectations are typically between 3 and 5, 3 and 6, the safer, quote unquote, side of the portfolio.
Yep.
And then on the more aggressive side of the portfolio in the market, you have things like stocks and ETFs and structured notes and sometimes mutual funds, although we don't use a lot of those, and things like that, the normal things people know to use to grow their money. But we can't continue to invest like we were 40 and 50 years old at the point of retirement because we can get burned. Our wages are ending, and we need income from our life savings to replace our working paycheck.
Right.
People get this and they realize, okay, I've won the game. This couple realized I have 3.2 million saved. They started working with us several months ago before this recent downturn. And there's no perfect time to work with an advisor, but it was a great time for them because they caught a lot of the up and protected a lot of their life savings before this recent downturn. The solution for them was that portfolio X-ray. We went over everything with them, Heather. We went under the hood on everything that they have, found out how much risk they were taking, recommended what we did, incorporated a lot of protection and a lot of other planning as well around Social Security, long-term care, and taxes. So if you say, you know what, Abe, that sounds like me. I sound like this couple in Gainesville, Virginia. I've got a few million saved. There's nothing I have that I know that's protecting me from all the risk to mess up my life savings, including market downturns. And I want to know more about that and how I can incorporate more protection. Go to theretirementkey.com, click on the Contact Us tab at the top of that page, and we can begin to have these conversations with you as well and give you that portfolio X-ray also.
We also have links posted in the show notes. If it's more convenient, just click there. Or again, find us anytime at theretirementkey.com.
Thanks for listening to the Retirement Key Podcast with Abe Abish. To learn more about Abish Financial Services, visit retirementkeyradio.com. And join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m., and 5 p.m.
Investment advisory services offered through Abish Financial Wealth Management, LLC, number 310633, a registered investment advisor firm. Financial professionals are not licensed in all 50 states. To find out if Abraham Abish is licensed in your state, please call 571-577-9968. Abish Financial Services is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Abish Financial Services, Inc., Virginia Insurance License number 127820.